Yes, so I'll let the team from Forsyth introduce themselves. I'm sure they've got a nice background they want to tell you. But this is our team from Forsyth Bar who are managing the TEL fund for us now. So obviously coming to the workshop to do a little bit of a presentation about SIFO in the future, what that might look like. So as you know, when we transition the TL fund over to Forsyth Bar, we use the existing Treasury Management Policy as our base for existing arrangement with Forsyth Bar, but potentially, not fit for purpose. But that's what they're here to talk to you about today.
Thank you, Sarah.
Welcome, Dylan. I'm not. Your hands.
Thank you very much. Well, thank you very much for having us. Andrew Bateman from Forsyth Bar in Hamilton. Matt Henry, head of our research team. George Mayer, one of our senior research analysts who pulled a lot of the SIFO document together for us. So thank you very much for having us today. My other colleague Roger gives us apologies. He's on holiday in the Marlborough Sounds at the moment, so getting the rough weather. So Jeanette's just bringing up the presentation that we sent out. So there was some documentation got sent out, the SIFO documents, and there's also a PowerPoint presentation that the big thing will be talking to. Matt and George will do most of the technical talking to that perhaps, and we like these things to be nice and open and casual. Questions as you go is best. So we'll Jeanette's just lining this up and then we'll be all good to go.
You've got too many emails, that's Jeanette's problem. She's just fine.
You asked her here, is this the?
Yeah, so Jeanette will move, but she's got
okay.
presentation.
So if you're worrying about the empty seats, we have a couple of members overseas at the moment, including the mayor who's about to disappear. Leonard is in Canada and Councillor Truman is stuck in traffic going to take a run.
Yeah, we did.
That's why we were on time, not early.
And just a reminder that the workshop's been recorded. So
sorry, I'll just get it out of my emails.
it'll be coming any second.
Is it meant to be a PDF?
Yeah.
Yeah. I just realised it was a PDF.
We control L will make it this ring.
Yeah. I just want to close my email so they don't pop up on the screen.
Control L stops it from popping up on the screen. So you
Does it mean that the credit pays here or
Yeah, and it's usually not one to give to us, then it was an interesting dish. And then fresh water.
There we go.
Okay.
All right, you want to lead off from there, Matt?
Yeah.
You're the leader.
I do.
If it comes out, I just back to my screensaver and come on so that it's the only thing.
Straightened up under this.
All right. Get off your hands.
No, thank you. Appreciate the time. And just another apology from us as well. We have a woman, Katie Beath, who's our head of ESG, who would have loved to have been here. We would have loved to have been here, but she is presenting at a conference this morning, so had a conflict. So another apology. Look, I guess we're just going to run. Look, I want this to be an open discussion as possible, but just going to run through, I guess, what we think are a few, I guess, key thoughts around the current investment settings. And I think it's important before launching it. So there's no definitive answer on these things. There is no right answer. Like ultimately, every decision you're trying to reach is a bit of a balancing act of a number of factors, and ultimately you got to land where you feel most comfortable. So we're not going to sort of tell you this is where we think you should be. We're just going to sort of talk about what the trade-offs are, and I guess potentially leave thoughts with you to mull over about where you ultimately want to land. in terms of, what the purpose of a SIPO is, it's not particularly complex document. Ultimately, what it is really just outlines the purposes. What is the money for? What are we trying to achieve, and how are we trying to achieve it? And really, the importance of it is that it gets everybody involved on the same page. And so, what you don't want is kind of, to use an American term, your Monday morning quarterbacking, where you sort of turn around and say, why did we do this? Markets are volatile, they can move around. Why did we do this? Like, whose stupid idea was this? It should be explained, in the SIPO, the thinking. And equally, it stops people making reactive changes. Markets are volatile, markets can be emotional, and typically people make suboptimal decisions in the wrong time. And it's not to say the SIPO is set in stone, but it's to say that there's a deliberate process that you work through if you want to change something. So that's really the reason for it. Just before kind of getting into the first primary discussion, it's first probably worth reflecting on, from a financial perspective, and there's other objectives, but from a financial perspective, really, you can kind of categorize goals into three areas. One is to grow the capital base. So we've got a pool of capital today. We want it to be bigger in the future, not to be bigger in the future, because obviously the larger that asset base, the more you can actually use it to fulfill the ultimate goals of the fund. The fund has a purpose. So the better the returns, the higher it is. The greater the ability to achieve the underlying purposes are. So objective 1 can be to grow the base, make it bigger. Objective 2 can be to preserve it in real terms. So say you want it to be the same in real terms as it is today. And objective 3 can be using the money, the profits from the fund, to undertake spending today, undertake allocations today. And often people have multiple goals. It might be, for example, to distribute some of the funds, but also preserve the real value of the capital base. So it's not shrinking in real terms by inflation over time. But there's a trade-off, right? The more money that you spend today, the less it's going to grow in the future. And so those are one of those things you're trying to trade off over time. At the moment, you guys have got what we'd see as a pretty conservative asset allocation. So high weighting in income assets and fixed income and cash, and a lower weighting in growth assets. And I say there's nothing right or wrong about that setting, but just being aware of that setting coming in. If you look at the nature of the organisation, a lot of the characteristics of the organisation would actually typically lend itself to taking on a higher degree of investment risk than you are currently. So the fact that you are a perpetual intergenerational organisation means you've got that long-term time horizon, and you don't really need to worry so much maybe what the year-to-year movements of the fund are. So that's one factor that may lend itself to taking more risk. Another factor that typically lends itself to taking more risk is flexibility around income requirements. If you're reliant on a steady stream of income year in, year out, you obviously want greater surety. But if you're flexible and you don't have any specific income needs, that again lends you to taking more risk. On the other side, factors that may be considered are things like managing all stakeholders, and we understand in certain organisations that there's broader stakeholders that need to be managed, need to be satisfied, and so look, one factor around being conservative may be the fact that you're a public organisation, and you've got to be sensitive to volatility. I guess the other factor is and maybe this can be part of the discussion, but our understanding as part of the use of the funds is almost like a self-insurance, so that if something significant happened and you needed the money, you can draw down on that. If that was potentially aligned with a troubling economic environment, again, that aligns itself with a more conservative setting. So, as I say, there's some elements or some characteristics of the organisation which lends itself to being higher risk than you've got, but equally we can understand why there's maybe a conservative starting point. But as I say, there's no right answer on it, but there is a trade-off, and maybe George can just run through some of the trade-offs, just so that you're kind of aware what you're trading off with those conservative settings.
Yep, thanks, Matt. So we've had a look at the appropriateness of the TAL fund's asset allocation in terms of meeting its return target of the 90-day bank bill plus 1 to 2%. So in this chart here, we have shown the performance of a conservative portfolio over the last 23 years, and you'll see it's in line with the upper end of the fund's return target. So largely, we think a conservative portfolio should continue to meet the objectives of the TAL fund from a return perspective. As Matt touched on earlier before, it is really a trade-off about lowering volatility on a year-to-year basis, sort of short-term, versus maximising the benefits for stakeholders in the future. And again, there is some reasonable ability for the fund to take risk given its perpetual time horizon and flexibility around making distributions. But then this is weighed against that, there could be external pressure from stakeholders and the fact that, you may need liquidity in a time of distress. Another point worth considering is just that given interest rates are, now higher than they have been for the last 20 plus years, it may be more difficult to hit that return target of the 90-day bank bill index plus 1 to 2%. I mean, just on the current number, it's about 6.7 to 7.7%, which is slightly ahead of what a conservative portfolio would have delivered over the past 20 odd years.
Excuse me, can you just go back to that last slide, the graph?
This one, yeah.
Just so conservative. I mean, there's the benefit of hindsight, of course. That's what this all is.
Yeah, of course.
Yeah. So, for example, the growth plus the grade, the top one, that would have been what a certain fund somewhere. That's how they performed.
So this is
what we would have performed like.
This is just assuming you get market returns across these various categories, and so in the conservative bucket, there'll be a high weighting of fixed income. So it's essentially how the New Zealand fixed income market's done, plus how a lower allocation to New Zealand equities and global equities have done. Whereas the top one has a minimum allocation from fixed income and a much higher allocation to equities.
Seeing like the recession 2008.
Yeah.
Okay, the conservative was the best performing for a few years.
Yes.
Yeah.
But not by a lot. Seems.
Well, I think that the scale also hides it, because if you think about if you look at that scale from 150 to 50, it's a pretty big fall. But on the graph, because you've got the big scale on the left, it makes it look not as bad. Look, as George was saying, that the key thing is really in those extreme periods, like we saw in 2008, 2009, and again, which we saw in 2020, early 2020 with the COVID crash, is those green, that you know, the pullback in that green line is much less than those pullbacks on the other line. And probably it's that 2020 time period where you can see it most clearly. And there's other charts later on, which George will highlight.
I also noticed that, like, even the worst of times, 2008, 2009, they're all sort of fairly tight.
There'd be bigger gaps.
No, but compared to the, well, now, boom times, what, 2016, 2020, in my mind, this looks like, yes, it's worth taking bigger risks because you make a heck of a lot more in the good times. But you lose a little bit less in the bad times.
Yeah, I mean, ultimately that's your trade-off. That's right. That's right. Exactly right. And so the high risk assets over time deliver higher returns, but it's a bumpier ride along the way. It's exactly right. And that's the.
But overall, yeah, you make a lot more.
Over time, you make more money. Yeah.
I think another.
If you a lot of this kind of, sorry, through the chair, does it, it can be quite difficult to understand in some instances, but I think the KiwiSaver was probably a good example of where people had their risk of their KiwiSaver, whether or not they were risking a lot or they were playing it conservative. And then when that drop happened, everyone went, oh, let's change it back to conservative now. And that ended up making them lose probably more money in the long term. If they had stayed the course, obviously there's the big dip, but it would have come back up again eventually. And it's kind of whatever, I think whatever decision you do make, it's important to just stay the course and weather the storm. It seems to always be, and I think those graphs are a great indication of that.
And that's why, back to the comment earlier about having the SIPO in the first place, is to prevent exactly what you're talking about. Is that emotional reaction when times are tough. And, I could tell you, and it's not only people in KiwiSaver, it's big organisations who can make those decisions as well. There's remain nameless, but a large iwi organisation that made a decision to go into global markets in the middle of 2019, and then COVID hit. And there was panic, and there were people in that organisation who wanted to pull everything out. Fortunately, they did not, because if they had at that point, it would have been a very costly decision. And so the reason for having that SIPO is that everybody understands that this is a long-term position, and we're not going to be reactive, because, as I say, it's those times where everybody's reading the negative headlines on the paper and the world's going to end because the world's sort of going to be okay. It doesn't grab the same headline as the global economy is going to collapse, and so that's what you're trying to protect against.
Obviously, you have to have some liquidity or reserves for emergency or disaster recovery funds, but I've always been a long-term advocate of we're a bit too conservative, but also running back to the former councillors. But I mean, I'm a fairly conservative by nature, ironically, but I think we probably could be a bit more of a balance of the smaller equities, etc.
Look, I mean, I probably going to be saying the same thing given this conversation we've just had, but maybe we can just touch on a few slides just to, I guess, highlight the point.
Yeah, so we've looked at a conservative portfolio versus the balanced portfolio as options for the fund. As highlighted, with a balanced portfolio, we'd expect that it would deliver a higher return over the long term, albeit with more volatility along the way, as this next slide shows. So this is best and worst annual returns for different portfolio types going back to 1998. And you'll see that this is the worst years were through the GFC. And for a balanced portfolio, it would have declined approximately 20%, while a conservative would have been around 12%. So in a bad year, you are going to be down more due to having more risk in the portfolio. But on a very long-term horizon, you'd expect to grow your capital more for the benefits of stakeholders. The other thing that comes with a higher allocation to risk assets, being equities and property in the portfolio, is it does typically take longer to recover from a drawdown. So if the balanced portfolio declines 20%, and this is based on history, it would have taken about, just over 3 years to recover back to its prior high following the GFC. Whereas for a conservative portfolio, it would have only taken about 2 years. So that's another trade-off to think about. There's also a higher likelihood of seeing a negative year in the portfolio in any given year. So looking back again across those 23 odd years, you would have seen a negative year in a conservative portfolio about 1 in 10. So, 9 positive years, 1 negative year. And for a balanced portfolio, you're going to see a negative year a bit more often, being sort of 1 in 6.5 years, 1 in 7 years. And yeah, as Matt's mentioned, there really is no definitive right answer. But it is worth considering that, over the long run, having a bit more risk in the portfolio and moving from conservative to balanced should deliver higher capital appreciation and therefore greater benefits to the stakeholders in the future. And then, just to touch on, again, you'll see you'd expect in a bad market for the balanced portfolio to be below a conservative, but, if you can take a very long-term perspective, it can be worth considering taking slightly more risk in the portfolio.
Another probably comment I just thought of sitting here as well is there's your long-term settings, but there's also, when we manage people's money, we overlay it with a sort of a short to medium term type view as well. And at the moment, actually investing in fixed income, particularly for an entity that doesn't pay tax, is actually pretty good. So you've got New Zealand fixed income securities delivering in the 6s and sometimes 7s. And if you're not paying on tax on, that's a pretty good outcome. So even though you're sitting here and saying, well, maybe we're taking, more balanced risk on a long-term basis, even if we changed the portfolio today or the settings today, we'd probably actually have still quite a high weighting in fixed income for the next couple of years, given those high returns that the normal on offer, and given some of the risks out there in the global economy. So just important to differentiate between sort of, I guess, a long-term expected target versus where you might set it today based on current market conditions. So I think that was our sort of probably first, and I was going to say equally probably most important discussion point is just for an organisation like yourselves, at first glance, it's a pretty conservative asset allocation. That's not wrong. It's just that it's more conservative than what you would see typically of a nature, an organisation that has a perpetual time horizon and has reasonable flexibility around withdrawals. So again, a conversation for you guys is, whether you're comfortable or not, you're taking on, I guess, a step higher in risk in the portfolio to benefit, for expected high capital returns over the longer term.
So if I reflect back to you, what I'm hearing is we have room to move in a less conservative direction without being reckless.
Yes.
Making, yeah?
Yes.
Absolutely.
Yeah. And I think the question I don't know the answer to, which only you guys do, is there much sensitivity around this from the broader stakeholders, your community? Often the unknown for us when we sit down with organisations is to say, yes, you can take on more risk, But if you've got quite a broad stakeholder group that you're trying to take on the journey with you, how comfortable are they in those sort of periods? And I don't know, we don't know the answer to that. So that's something for you guys to think about.
Through the chairs, stand the policy as a community fund, you know, they're seeing the gaming, they're taking it.
Exactly.
Risk on
Yeah.
investment like this, so.
Yeah.
But look, I guess for me, it's a question of being a good steward of the assets that we are looking after. Like you and our task with looking after on behalf of the community. And I guess from my perspective, it's we could take an ultra conservative view and miss out on opportunities we could and arguably should have taken advantage of on behalf of the community. Or we could take a slightly more risky approach, less conservative, and capitalise on things for the benefit of the community. I guess that's a trade-off. People will see negative numbers and react negatively, and no disrespect to a lot of people, but people don't understand the investment markets. You lose $10 today, you gain $20 tomorrow. Only focus on the loss. So I welcome this conversation in terms of stepping up from a slightly more conservative fund to a more balanced approach.
So through the chair, just 2 points. One is, well, how much, I mean, I've never taken an interest in it. Or from the outside, how much visibility of where this gets invested is there to Joe public anyway? And are there people out there keeping an eye on this, or no one cares, or no one knows, or what is the answer to that?
We get updates every month.
Yeah.
And so there's lots of transparency in terms of returns as well as your key.
People out there who are harassing council for being too conservative. I mean, is it a public concern issue? Do you know?
It is 100% transparent, 100% available for anyone who chooses to read the document. Nothing is hidden in that respect.
So are there
meeting agenda?
No, I'm just wondering, you know, we could just play with what we want and no one would really notice because no one really cares out there. Is it kind of like that? No, I mean, are people keeping an eye on this? Are there financial wizards out there keeping an eye on this?
Oh, hello, we've just contracted.
Yes.
Those financials. With
No, in the public, the community. I'm just talking about the community.
Absolutely. Yeah.
There are. Okay. Okay.
Too big.
Well, okay. But the second question is, well, the advantage, I think, which you were saying was, well, conservative. Am I hearing this right? That in the event of a disaster, we can pull money out of it more easily and cheaply. Is that sort of?
No, I think so. The enemy of taking a higher risk is if you have short time horizons. And so, for example, and we'll talk about an individual here. Yeah, let's say an individual had a job like us in financial markets, and the time they might want to withdraw down on their funds is when financial markets collapse and they lose their job. So if there's a chance that all else being equal, that you're more likely to have to withdraw the funds during a period where there's an economic challenge, then all else being equal, that would take you to a more conservative position, or relatively. So,
I think for Chair, we've got to remember too that this isn't the only source of funds available. So we've got debt headroom, we've got other term deposits and other cash that we can use in those cases. And likely, if the unlikely, you know, in the event that something happens, touch wood, there would be other mechanisms we could use in the meantime. We wouldn't have to draw out the fund straight away necessarily, because that's and again, you generally wouldn't. If something happened, you don't spend the whole lot up front. So in the disaster situation, there's other mechanisms. So it would give these guys time to release the funds, as you know, also as makes sense.
And Sarah, it's self-insurance for underground assets.
Underground assets, not above ground. Yes. Yeah. So
for example, that water thing at the water project.
yeah.
So I was making it clear that it currently is a self-insurance fund for underground assets. I guess part of it is there'll be business of underground assets for the wastewater system in the future. So I think there's further flexibility. The risk profile of the changes that we see.
Yes, I'd just like to comment on that because I know you.
We are recording this. I just wanted to use that microphone.
Oh,
So
sorry.
if you're speaking softly, it might not pick it up.
I just wanted to comment that in your presentation, you did say it's a 6-week notice period to draw down funds. That seemed to me to be quite a long period of time because in actual fact, we would only be drawing down on this money in an emergency. But having said that, how often would you expect to make a distribution to the council anyway? Annually? How often? Or is that up to us to
So,
decide?
yes, and through the chair, and that's what I was going to just jump in and defend Andrew. Andrew and the team were actually proposing a much shorter time frame. And I said, look, we've got other cash, we've got debt headroom, we've got money readily available to us. And I said 6 weeks would be fine. And that gives them the comfort that, you know, it takes time, obviously, to unwind things. And to be fair, we probably wouldn't ask for it unless we had to anyway, because you obviously wait till the next period of interest or when it makes sense to get.
But my point is that if we needed this in an emergency, 6 weeks is too long, even though you say that we've got other money. Well, you don't know what the emergency is. This is the point that when you talk about an emergency. So not that we would ever expect to draw down a huge amount of money in normal times because we would already have set in place how often our distribution was. It just seemed to me to be far too long.
Yeah, we have more available to us in debt headroom and current cash than what's in the fund. So,
and look, 6 weeks does, I share your view. 6 weeks sounds like a long time. And so we can work with something that's definitely shorter than that.
And just, if I may,
Distribution time is fixed, isn't it, Sarah? I mean, annually, there will be a distribution annually or whatever.
that's up to us.
That's up to us to
Yeah.
decide. So we would be looking at an annual distribution. Is that something we would be thinking?
Yeah, again, currently in the Treasury Management Policy, it says we want to retain the fund plus inflation. So likely not unless we change that. And again, in the past, we haven't necessarily been doing that. We've used it for rates, subsidising rates and other projects and that sort of thing. But currently in the Treasury Management Policy, it says we want to retain inflation. So we'd be retaining it in the fund. So that would just reinvest.
Yeah. And just on that, if I may, when we had the discussions about the 6 weeks, yes, we said, well, it can be a lot shorter, but if the disaster happened, you don't need the money the day of the disaster. You need it for the repairs and whatever, which isn't going to be that day. And if it's a physical disaster, then you've got immediate reserves and things to draw down to determine how much you need, what time frame. If you happen to do that at a time, as Matt said, when you're in a downturn, that also gives us time to say, okay, what's the best way to navigate out of this? So yes, money can be available on a much shorter time frame, but it was in that sort of higher consideration that we took that 6 weeks. But again, that can be changed.
Yeah, so we just got our quarterly Treasury Management report. I haven't opened it, so I won't tell you the exact number, but it's about 117 million we've got in debt headroom, and so it's about twice the portfolio that we've got in debt headroom and other cash.
You think you just to flip back to what the CE was saying about the insurance underground and not everything else, and if there was a natural disaster of a type where you needed to break an investment like that, the central government would certainly step in. There is the Disaster Resilience Fund, which is something that is available. And also if it was a declared emergency, there are different powers under different acts to ensure that we can be moved forward into a place of recovery. So I think that's all good.
Yeah, just quickly, out of interest, what does it take to withdraw money from investment? Like I would say that, the 6 week period is probably right. Like, is it quite a lot of work involved in, it's an investment, so it's not as if the money's sitting in a bank somewhere, right? So there's a whole lot of processes that need to happen in order for that. I'm just out of curiosity, what are some of those processes?
Yeah, so to answer that for these things, the investments we have are going to be what we call liquid, so therefore able to be sold pretty quickly. on investment markets in New Zealand and around the world. The question would be to give the time to make the best decision. And again, if you're doing that in a hurry, is it because it's a physical thing or economic thing that's disrupting the value of those assets? Like Matt said, you don't want to be doing it when things are on the way down. You want to be considered. If you're talking about normal everyday days and you said, oh, we need X dollars to fund Y thing, oops, we can't access that at the moment, can we have funds? Then yes, we can get that for you in sort of 5 to 10 business days, you know, from a liquidity point of view. Is that the most optimal way of doing it? Not really.
Well, it depends on the conditions.
Yeah.
Depends on the environment we're in.
Yeah, but in a normal everyday economic,
Which is exactly what the 6 weeks was kind of, when we discussed it, that was kind of referencing that, because we wanted to make sure that if we do make those decisions, that it's in the most sensible way of getting the investment out with the least cost or the maximum return. One of them.
Yeah. What project to get through? Don't you have a question and then we might.
Yeah, just a real life example. A few years ago when the waterfront, the water pipe bust, is that an example when this was drawn upon to?
Through the chair, no, the blowout at the lakefront was covered by our general reserves and stuff. We haven't touched the TEL fund for capital repairs for years.
Okay, so that, I mean, I guess that's the first big picture question, which is, you know, do you feel more comfortable taking more risk? I guess just reflecting on this conversation, you know, given the kind of unique potential needs for the fund, given the long dated horizon, given the other potential channels, whether it's current reserves or government, it probably reinforces my view that you are in a position to take more risk if everybody felt comfortable. So that's, I guess, would leave that for you to reflect on, but I'm happy to come back with an alternative if that's of interest. The next one gets, we've covered all of that. Next one, this gets a little bit more nuanced, which is at the moment, your breakdown is 50% fixed income, 10% cash. So it's the conservative part. Then within your equities, high risk part is 10% New Zealand and Australia, 15% global, and 15% in property. In listed property assets. So this is not physical property, it's listed companies. That's quite a high weighting for anybody to have 15% in property assets. I suspect the reason for that was that people typically look at property as an income asset, as quite a low risk income type asset. The challenge for any non-taxpayer is it's actually not that tax optimal to invest in property, listed property companies. And the reason for that is everybody in a property company is essentially has the same tax rate. So if you're a 39% taxpayer, you essentially have the same tax rate as you do for a 0% taxpayer. And this is just a quick example. So and shout out if this needs explanation, but for you guys to get 6% in a bond, you keep 6%. There is no tax, right? If a 39% taxpayer gets 6% in a bond, they get 3.7% after tax. So quite a different return post-tax for you guys versus taxpayers in a bond. With a dividend from a property company, everybody gets the same. So at the moment, it's about 4.8%. And for you, post-tax, pre-tax, it's the same thing. For a high taxpayer, that 4.8% is the equivalent of getting nearly 8% pre-tax. So you think about post-tax, the high taxpayer says, I can either get 4.8% from property versus 3.7% from a bond, whereas you guys say, actually, I can get 6% from a bond versus 4.8% from property. So does that make sense? Like on a tax relative basis, property actually isn't that great for non-taxpayers. You don't benefit from that tax shield. So we think that having 15% in property is very high. And so we would think about, our recommendation is thinking about moving more of that actually into international stocks, the global markets. And the reason for that is really threefold. You know, one is high expected returns over the long term. Two is the fact that global markets provide a lot more opportunity and diversification benefits than what you can get in New Zealand. You know, New Zealand is 0.15% of global share markets. And even if you add Australia, it's only 2.5% of global markets. So the world's a big place. You know, there's a lot of opportunity out there, but there's also, importantly, a lot of different sort of assets that you can get in Australasia, which diversifies your risk over time. And that's really important. This chart basically just shows you that how small the New Zealand market is. You know, you've got 15 companies that make up more than 75% of the market. So New Zealand is a small market and concentrated only at a few, you know, not that many companies. And when I talk about diversification, one of the important things about having offshore assets has been that when the global economy goes through challenging periods, the New Zealand dollar typically falls. If you think back to the global financial crisis or COVID, or even back to the dot-com crisis 20 years ago, typically when people become conservative about New Zealand, worried about the world, they seek safe haven in other markets outside of New Zealand. And that risk, if New Zealand ever saw a significant shock, you know, whether it was a major geographical event, or, you know, significant economic shock, you know, mad cow or something like that, New Zealand dollar would fall quite significantly. And by having that offshore exposure, you know, you have a balance in your portfolio to offset some of those local risks. And I think any New Zealand investor, entity or person, you know, when you think about, you know, your house, your business, your assets, your rate space, are all in New Zealand, having some diversification outside of New Zealand, I think, is important. And at the moment, as I say, like your overall allocation to global equities in your equity basket looks okay. Your global allocation to global equities within your whole basket's quite low, and that property part feels quite high. So, yeah, our recommendation would be allocating some of that property money into global.
What percentage?
Look, I think the justification for having any property is low because of those tax benefits. So, look, I would say most to all of it.
So having said that, I mean, the residential property market here has gone nuts the last little while.
So those assets are commercial property. Yeah.
About residential. I mean, for example, if you're throwing a whole lot of the TEL fund into residential property 7 or 8 years ago, we'd be laughing. But I mean, it's hindsight.
Well, I don't know if you've been laughing right now from where it was a few years ago. Look, I think, look, again, that's right. I mean, all assets did well. We can get into a discussion on residential real estate and have some strong views on it. But what we're talking about here is commercial real estate. And let's say the fund decided, well, actually, we want commercial real estate exposure. There are actually other options, as a broader conversation in private markets, that actually don't have the same tax disadvantages these do. And these companies that are listed on the New Zealand market have been actually very poor at growing their dividend yield over a long period of time, for a whole bunch of reasons. And so really they are just income assets. And, you know, when you've got the advantage of not paying tax on bonds, why would you invest in something that's actually quite punitive from a tax perspective?
Well, only if it's sky high profits, I think. So
that's you know, all we're saying is, from a tax perspective, there's quite a high hurdle for a not-for-profit to own a lot of listed property in New Zealand. And it's specific to those listed property vehicles and the tax structures that they're in. And if you go back to this, for example, chart today, you guys are getting 1.2% better return on a corporate bond, which is a lower risk asset than property, compared to, say, a high taxpayer who's getting a 1.1% better return on property. And so there's actually a nearly 2.5% difference in tax between a zero taxpayer and a high taxpayer on the two assets. So it's quite significant, over a long period of time.
Correct me if I'm wrong, Matt, but I believe it's only one of the New Zealand listed property companies that's grown its dividend since 2008.
I think it's since 2000.
Since 2000.
So they haven't been great underperforming assets, underlying assets anyway. So that was kind of getting into the more nuance. So as well as thinking about, whether you take higher equities, we would recommend reallocating that away from being quite heavy in property, which you are at the moment. Are there any sort of further questions on that before? The last sort of topic of conversation I want to get into was something quite different, which is around responsible investing in ESG. So ESG, for those, again, apologies for people who do know, is environmental, social and governance. And it's quite a broad-ranging, nuanced topic. And we're very fortunate at Forsyth Barr to have Katie. Katie joined us from New Zealand Super Fund in the end of 2001, and she's one of the, I guess, foremost leaders in ESG in New Zealand. And so the invitation is there at any stage. If you want to have a more deep conversation about this, she's available, and she would have been here today if she hadn't had that conflict. I guess ESG, again, there are no right answers, and there's a layer of commitment you can have to it. But I think there's some things that we would, encourage. Look, before jumping into it, I think it's important just that you're aware that Katie leads quite an extensive engagement from our firm, particularly with New Zealand companies. So we end up talking about corporate behaviour, and we'll talk about carbon emissions. Part of our role in general is to engage with particularly New Zealand corporates, but also all corporates that we have investments in globally, to understand what their current practices, but also encourage them to improve over time. So that's just something that happens anyway. This is probably not particularly clear, so I won't dwell on it, and I'll touch on it as we go through. But there's sort of multiple choices that you've got when you're thinking about bringing responsible investment thinking or ESG thinking into your investment portfolio. The first one, which is kind of a bit of a no-brainer for an organisation like yourselves, is just, what are the headline risks that you want to avoid? And I guess back to this gentleman's question earlier about, who's out there digging into the portfolio. The answer is you don't think anybody until they find something that actually sounds good on a headline. One thing we're really trying to avoid is, headlines of, Taupō District Council owns X. So that's one part of your, I guess, what we call exclusions. What are the things that we don't want on the front page of the paper that we really want to avoid? You can actually go deeper on that as well and say, are there other values of the organisation that we also want reflected in the portfolio? So we use various work of our own. We use an external provider called Sustainalytics that sort of delves into every organisation around the world. We do our own locally because we don't think the global providers do a great job in New Zealand because we're a small market. But these are just examples. Screens on McDonald's just talking about what sort of some of the controversies associated with McDonald's are a screen around Coles, which is a supermarket group in Australia. You know, where does it come out of things that people typically want to avoid? Alcohol and tobacco is one. The reason we include supermarkets in there is because often this gets into a grey area. So people say, I want to avoid tobacco, and you say, okay, well, that's obvious from a tobacco manufacturer, but where does it end? And the same with alcohol, where does it end? So that's just part of the conversation. What we've put forward, and again, it's in the documents, is some suggestions, which are the ones that are here are bolded. But there's also a broader list of other things that you can consider and that we can exclude. So, as I said, there's no right and wrong answer on any of these things, and ultimately it comes down to a person's or an organisation's own preferences of what they're looking to avoid. At very least, we'd expect that you'd want to avoid, you know, anything that's in KiwiSaver and probably New Zealand Superannuation Fund type restrictions, because it's an easy starting point. But as I say, there's a list of things here which we can, you know, talk to probably a high level. Katie can talk to a deeper level. You know, we've made some recommendations, but you know, we're happy to, you know, talk about any specific things that you think need discussing, or leave it with you to kind of mull through it on your own time.
I suspect we'll probably go through these as a line item.
Yes.
Exercise, but just a couple of quick questions on the attachment that was sent to us. You've got that, but we've also got a percentage revenue threshold on the side. So if you set the top one, adult entertainment is greater than 5%. Can you explain what that is or how that works?
Yeah, so as you can imagine, you've got some of these big organisations around the world, and if you dig deep enough on some of them, you can find they've got some very small exposure to something.
Like Amazon might be flagged for adult entertainment because it sells a certain product, but it makes up 1% of their revenue.
0.01% of revenue.
So you have those revenue thresholds so that it kind of just screens out those that actually have heavy business within the.
So if you take a for instance, if you wanted to avoid modern day slave or child labour in third world countries, so we would not be investing in anything, probably looking at anything any of us are wearing right now.
Yeah, so what?
So you look at how far or how big.
And that's right. And so there's a few ways. So there's a few ways that we look at it for people. So there's categories, you know, like as you mentioned, entertainment being the top one, and then you get into things like controversies, UN Sustainable Development Goals, and you can say that we don't want any organisations with what are deemed high-level controversies, or at least we want to consider individually any companies with high-level controversies. We don't want any companies that are operating at a high level against UN Sustainable Development Goals. So you can have those sort of cross checks within portfolios. So yeah, the revenue threshold is just to remove the fact that if you know, like another one might be a cruise ship operator who serves alcohol. And so if you've got zero tolerance for alcohol, you know, then theoretically, or a hotel operator who has a bar, you know, those sort of things. You're just trying to take away those kind of really small contributions that if you took everything on the letter of the law, then they potentially would be restricted out. And also difficult to find, and you find out after the fact type thing.
So, Chair, are we going to have a list of the companies that we are invested in, or are there some portfolio accounts that we might see? No, so we will have, because one of the things that investors have to be aware of today is greenwashing, as I'm sure everybody is.
Yep.
And it's very easy to make a list like this and think that, well, gosh, who in the right mind wouldn't agree with every single one of those? And as you say, you start to go deeper into organisations such as supermarkets, Countdown, Woolworths and so on, who all sell tobacco. And you can work your way through all of these. I mean, we've got a dreadful situation going on in the Middle East at present, and we don't know where that's going to go. And we say, well, we're not going to have that to do with military companies. Well, that's a bit two-faced, really, isn't it? You know, so I hear what you're saying, and I understand what you're saying, but greenwashing has become a little bit too holier than thou.
100% agree.
Yeah.
Could not agree more.
I would be very wary of that.
Yeah, look, we're not talking about greenwashing. We're talking about aligning the values of what you invest in with the organisation. And there's a spectrum, right? You know, there's a spectrum. I've sat down with somebody who drives an electric vehicle, has, you know, has solar panels on their roof, and says, look, I'm a realist. I'm happy that fossil fuels are going to be around for the next 20 years. And so why would I preclude them? I'm doing my bit. But again, you know, it's a choice. And I think for an organisation like yourself, at very least, there's things that you just want to make sure that you're not involved in for the public perception risk.
Well, for us particularly, you know, Huntley's just down the road. It's owned by Genesis. Those sorts of things will be difficult for us, because actually that really goes against who and what we are in lots of ways. So when you start to look at what we're talking about, those are the things that you will keep in mind.
Yeah, and look, again, you know, as I said, it comes back to you making decisions about that balance, right? And so I think there's some relatively easy things. Your point around weapons manufacturing is an interesting recent case in point where, you know, it's become a bit more unclear recently, you know, is defence a necessary bad? What we have, you know, what often people exclude as controversial weapons, so things like cluster munitions, rather than going, I'm not going to have defence at all. But again, what we try to do is provide something that's tailored to you, and so therefore it's really your list, not our list. And you know, to the chair's view, it's really probably something that you kind of want to work through yourselves and all feel comfortable with those outcomes. If you have any questions around anything specific, you know, we're more than happy to provide more colour on individual line items.
Yeah, thank you for that. That is helpful. I guess my question was around, which you've asked, it's around layers of ownership. So you invest in a company who also is part owned by somebody else, who's part owned by somebody else, who might have involvement in one of these industries. And it's, you know, again, how deep and how many layers can you go through for you?
Yeah, and look, there's never a perfect solution, right? And so, you know, we locally do it ourselves, and New Zealand market's not that big, and the companies aren't that, so it's, you feel pretty confident. Globally, you know, you can never hand on heart say 100%, but what you can have is a statement of intent, a policy to try to implement it as best you can. And if new information becomes available, you respond to that information that becomes available.
So through the chair, just a little, so we're trying to put some numbers on it, like 5%.
No,
Was that the value?
the 5% was just, so often when you look at these things, you know, rather than making a blanket statement, I'm not going to buy anything with alcohol. You say, I'm not going to buy anything without alcohol that contributes over 5% of the revenue.
Also, so 5% of revenue, and you can get that information.
Yes,
you can.
Yeah. So we have external providers who provide we subscribe to services with global partners who provide that information.
Get that.
Yeah. So that's kind of I think for me, that's kind of minimum from a I guess an ESG policy or a responsible investment policy. The next, I guess, discussion is really around whether there's any interest, desire to do anything around low carbon. And I guess when we looked at your objectives as a broader organisation, we thought that may flow into interest around the portfolio. Again, look, there's no right answer. You've kind of got a few solutions. One is I guess establishing a relatively low carbon portfolio to begin with. We do that for a number of clients. Secondly, monitoring the portfolio over time to sort of monitor the path of what it looks like. Thirdly, as I mentioned earlier, we continue to engage with the companies who are invested in around what they're doing. And the fourth one is, so that's kind of all related. The fourth one is whether you think about investing in climate specific investment opportunities. And if we did that, we would think about doing it through a global manager with expertise in that space. And the merits of doing that are kind of, for me, from an investment perspective, solely a twofold. One is diversification, which I've already talked to. But secondly, I guess it's the same thing really, but if you think about most investment assets, they're driven by kind of macroeconomic factors largely. So it's, what does economic growth look like? What does inflation look like? What does interest rates look like? I guess the diversification of benefiting things that may be influenced by climate changes, they are other factors, they're government policies, they're whether the climate actually, whether climate changes and how much, to what extent it does, and initiatives to mitigate against that. So that's another option as well. But to sort of just touch on the first bit, just a couple of examples. This is a screen we provide, a number of clients who want to understand what the carbon intensity of their portfolio is over time. This is a statement, and this is public, so that's why I'm including it. This is a statement that the Wellington Community Fund released recently, which is a joint commitment from us and them around decarbonising their portfolio over a very long period of time. But again, I only put it in here just to highlight, how we're trying to work with people who have got ambitions in this space. So that's just, as I say, that's a high level discussion around carbon. Happy to go into detail. It may be something that you say, hey, we might want to do this in the future, but not now, and that's fine as well.
My response to that would be, initially, we have our own in-house climate change policy, which we voted on narrowly the last millennium. And whatever we did, although that does not speak to investment options specifically, correct me if I'm wrong, Nick, relying on my memory here. But we would need to be at a minimum consistent with what our existing internal policies are.
Yes.
So if we're saying one thing in a policy that deals with a whole range of stuff over here, and yet our investment settings are, diametrically opposed to that, that would create a little bit of dissonance, really.
Yes, and that's why we sort of, I guess, flagged it, as to highlight, again, you don't want that inconsistency. I think you, when I talked to Katie about this, and she said, well, you're not going to get exact consistency because, they're not potentially possible to align exactly, but at least philosophically you want them to be aligned.
My main policy in the next few months, so that is a group is something that would be good to have in the back of our minds, I think. Like a big thing on them.
I know, and I think we're very aware that our auditors, even through the LT people, we're taking a very close look at how we're responding as an organisation to climate change.
Yeah.
Also focus that we have with all councils.
Yes.
So I think it is a decision that this council will need to make. Not only on the policy, but on investment as well.
Okay, look, again, we can put some thought to that and come back with a policy that might work. Just the last, I was going to say, I'm pretty confident it's the last point. I guess from a, as I say, from a, from an ESG, responsible investment perspective, there's really, as I say, those exclusions and carbon are probably the two big things. The other thing is just really, how much interest, and again, maybe with something mulling on over time, you think about wanting to have some of those investments in impact type opportunities, or at least sustainability linked opportunities. And probably the most interesting one, I think, in New Zealand at the moment is rising opportunities around providing housing, whether it's debt or equity products, and some of them are purely social housing. Some of them are low, more affordable housing, or a combination of both. And so when we sort of talk with organisations like yourself, often the feedback we get is, yeah, we're kind of interested if it's local, if it's in our region. That makes it more challenging because opportunities don't necessarily always come up in your region.
Heavily engaged, I was going to say invested, but it's probably in the current context, I'm going to send the wrong signal, but yeah, we are right dead smack in that lane at the moment.
The frustrating thing for me on this space at the moment is that you actually don't have to give up. Like, a lot of the products actually out there are actually reasonably commercial returning. It's not like you're actually necessarily giving up a lot in the way of returns from some of these things. But there's this newness element from people, and it's like, I haven't seen this before. What is it? And the other challenge for yourselves is it's at the moment it's all private markets. So it's and in the SIPO currently it says public markets only. So that's just something that you would have to also think about. I think it's it's clearly a, from the earlier conversation, a major issue in New Zealand, housing affordability. There are these entities that are trying to at least contribute something to the solution, and more of them are becoming investment opportunities. And so, as I say, if it was something that you wanted to learn more about, it would require a need to be able to allocate to private and alternative investments within the SIPO. It would never be if you did it, it would never be a huge allocation. But I guess it's one way that you can sort of think about, contributing positively with the investment dollars you're making.
It doesn't go against your recommendation before about investment in property.
No, because the previous comment was all about the tax structure and the fact that the tax structure of listed property companies in New Zealand is beneficial for taxpayers, but not beneficial for non-taxpayers. So it's not about the inherent underlying property itself. It's about the vehicle they're in and the way that tax is applied. And that's commercial property, and this is residential property. And so there's multiple vehicles. For example, at one end, there's an organisation, Community Finance, which raises debt for organisations like Salvation Army to help fund new developments. There's other organisations where it's actually equity and you actually own the housing assets as well. So there's multiple options, and there's a spectrum of risk. The Community Finance, who is raising debt for Salvation Army, it's basically government backed. Like it's pretty low risk stuff. Obviously, if you're taking equity ownership in housing, it's a different risk profile. So there's a range. And I guess, the reason we raise it is just because trying to find genuine investments that actually add some value. Yeah, to your point in greenwashing, there's a lot of stuff that people sell that has a nice green label on the tin, but actually, you know, the efficacy of what it delivers is pretty minimal. You know, it just sounds like a nice package. You know, I think this is one area where you can say, actually, you know, we actually are providing some impetus on something that's needed in New Zealand.
We have no idea how timely the last comments were. Thank you for that. Or how on point.
Good.
Particularly right in the next presentation, but
Let's just stay on.
I'll leave it at that, but no, very helpful, thank you.
Sorry.
Are we invested in any resource mining of any sort of? I personally think uranium is a pretty good bet looking forward, and I don't see any reason. Are we in any way in that space?
So at the moment,
No.
we haven't invested. Mate, you're still the funds are still being passed over.
Do you think that would be a red flag to some people investing in oil? Do you think it would be?
But
I agree. Well, we can be nuclear free, but we can still.
I recommend you have a look through the attachment you got in your email on the exclusion screening capability and this conversation we're going to have. You guys want to answer, that's fine, but I suspect it's an unfair question, so we haven't gone through.
No, I haven't got serious. I didn't see it on that one anyway.
No, look, we can screen for nuclear power. I would say this is a gross generalisation. I'd say the view on nuclear shifted reasonably in recent time because obviously it's a non-carbon emitting source. So you don't, you know, I think if you'd gone back 15 years, you'd have a lot more people adverse to nuclear power than today.
No, I think I'd foresee a boom time for that myself.
Yeah, thank you.
And in terms of, sorry, just next steps. So I guess the probably 5 things. In terms of the portfolio, I hear some interest to think about taking a high risk weighting. We can come back to you on some suggestions if you like, and some a reflection on what current versus that alternative may look like. Probably included in that is something around property, the current property allocation. Just reminding myself, in terms of the exclusions, I think that's really in your hands. So, I mean, we're happy to walk through it, but I think it's really in your hands to come back and say, you know, yes, no, or please provide more information.
Yeah, I agree. I think it is. And so Julia and Sarah, Jeanette, I'm open to input from you here. I just wonder whether we go through that, providing we're all clear in our mind. I'm talking to the elected members now. We have an understanding of what the revenue threshold means. We're quite clear if we're going to have this discussion and that it's done at a strategic level, ruling stuff in or out, and we understand clearly what it is we're asking of ourselves to come back to you guys. So that will be a task we're going to attend to. Timeline on that?
Yeah, I'm looking at Sarah around timeline because obviously we've got a sort of an interim cycle at the moment that we're kind of operating on as we transfer over. The timeframe for actually getting the final SLIPO in place.
30th of June, so not through the LTP because we've mentioned in the Treasury Management Policy that the investment will be managed outside by the SIFO. So I think we've covered ourselves there, but obviously the sooner the better.
So I'm thinking in terms of disruption for your investment team, what's an appropriate timeline to come back to Forsyth Bar with our input on this? What I don't want is you go away and do a whole lot of investments on our behalf, and then we come back and go, oh, by the way, here's what we decided, you have to undo all that stuff.
And we have a workshop with Katie first.
Yeah.
I mean, she's available, she's been offered for it.
Yeah,
That would be the, that'd be a suggestion, wouldn't it?
Entirely up to you. I mean, probably she'd be more than happy to come down, I'm sure, but it may be a Zoom thing, may be easier for yep, we can organise that, and look, that can be done on a very short time horizon, more in your camp.
That would be helpful, and look, no disrespect to us, and I'll include myself in that. I don't want to be in a situation where we're showing our collective ignorance. And come up with a whole lot of things which go against the grain in terms of the direction we should be going. And if we've got someone who's an expert in this field,
Yep.
that would be really helpful.
Well, I think that's a good idea, because I think we'll be able to give you a sense around what some other similar organisations are, how they've managed through it. So I think that's probably much, like infinitely better than we can. Yeah. And I that probably, to be honest, that probably the carbon thing is probably part of that conversation as well. And the housing thing, it probably all wraps up into that. So yeah, look, we'll get back to Sarah with either you provide us some dates that work for you and we, or vice versa. Probably easiest if you provide us some dates that work for you and we can.
We'll leave that purely the team to yes.
Perfect.
That's great.
Very good.
Any other questions, team? Thank you, John. That was really insightful, very helpful. Let's see where we go next.
Thank you. And look, just as a standing offer, you know, we're, I guess, always available. You know, if markets are, you know, not doing what we want them to do, or you've got anything specific questions around what's in the portfolio or anything like that, then we're always here to address.
Expect to see you every 3 months here.
Whatever you like.
So we got our first monthly report from the team this month, and Jeanette and I are just trying to figure out how we incorporate that into council agendas with our treasury report as well, our regular treasury report. So we're just trying to figure out where it sits, whether it's risk and assurance, whether it's full council, what frequency. So we're working that out, and we'll figure it out as a team. What works? Yeah.
Thanks very much.
Cool. All right. Thank you.